Good evening. Come to the next paragraph, which is called measurement period. Now, in this standard, there is one important paragraph, and that is related to measurement period. What do you mean by measurement period? So, first we'll understand the concept behind it. Suppose this is the date of acquisition. Let us say 1st April 2020. Okay. Measurement period is 1 year from the date of acquisition. 1 year. So let us say the measurement period will go up to 31st March 2021. What is the purpose of this measurement period? Purpose. In the last few hours you have learned that we have to calculate the fair value of consideration. We have to calculate the fair value of net asset. Okay, we have to calculate the fair value of NCI, etc. all on 1st April 2020. So what is the challenge in practical life? So much fair value cannot be calculated in such a short span of time. So you are allowed to do accounting on the basis of provisional figures. That means even though accurate amount may not be available, you can do the provisional figure, and then you are given 1 year time. You are given 1 year time to find out what was the fair value on this date. Then you can take the help of expert. You can do the calculation, and if you find that the figures have been wrongly mentioned here, you can do adjustment to those figures. Okay. So for example, you have taken land here at 2 lakh originally, but when you do the proper valuation, you find land value is 4 lakh rupees. Okay. So this 2 lakh rupees you will increase in the value of land. With the corresponding second effect will go to goodwill, right? Or gain on bargain purchase. This period of 1 year is called measurement period. But if the fair value you find after this period, then that will be treated as change in estimate. And you have to apply IS 8 there. Now when are you allowed to change the provisional figure? When you get more information about a condition which already existed on the date of acquisition. When you get more information about a condition which already existed on the date of acquisition, then you will revise the provisional figure. But if it is related to a new condition, then it will not be called measurement period adjustment. Then it is a new item, it will be accounted separately. So it should relate to condition which is already existing on the acquisition date. Further information should help me to arrive at fair value as on acquisition date. So this is about measurement period. IFRS 3 provides a measurement period window wherein if all the required information is not available on the acquisition date, the entity will be required to do the purchase price allocation on a provisional basis. Okay, this paragraph is understood. During the measurement period, the acquirer shall retrospectively adjust the provisional amount. So 1 year time is allowed. Up to 1 year you can go backward and adjust the provisional amount recognized at the acquisition date to reflect the new information obtained about facts and circumstances that existed as of the acquisition date, and if known would have affected the measurement of the amount recognized as of that date. Next paragraph. Now, which kind of information you will incorporate? This new information that you get should relate to facts and circumstances that existed as on the acquisition date. Is it right? But remember, if the facts and circumstances arises which is altogether new facts and circumstances will not be considered. If suppose new court case arises after the date of acquisition, that will not be considered. New tax law amendment takes place, that will not be considered. So what is the measurement period? 1 year. From which date? From the date of acquisition. How will you give the effect of the adjustment? Increase or decrease in the net asset acquired due to new information available during the measurement period which existed on the acquisition date will be adjusted against goodwill. Okay, so we'll adjust it against goodwill or gain on bargain purchase. After the measurement period, if you get information which will affect the value of asset and liability, then you will account for it as a error as per IFRS 8 accounting policy, change in accounting estimate and error. Earlier I had said it is change in estimate, but you will call it not change in estimate, but as an error. And follow IFRS, not IFRS 8, IAS 8. IAS 8 principle. Is it right? Now we'll discuss a small question on this. Entity X acquired 100% shareholding of Entity Y on 1st April 20x1 and had completed the preliminary purchase price allocation and accordingly recorded net asset of INR 100 million against the purchase consideration of 150 million. What is net asset recognized? 100 million. Consideration 150 million. So entity Y had significantly carry forward losses. Entity Y had significant carry forward losses on which deferred tax asset was not recorded due to lack of convincing evidence on the acquisition date. However, on 31st March 20x2, Entity Y won a significant contract which is expected to generate enough taxable income to recoup the losses. Now, did this situation exist on 1st April, or this situation of enough taxable income have arisen after the date of acquisition? After the date of acquisition. Because this is the profit figure after the date of acquisition, which suggests that you can adjust the losses. This is not additional information that was in existence on the date of acquisition. This situation or condition have arisen after the date of acquisition. Question is, accordingly the deferred tax asset was recorded on the carry forward losses of 31st March 20x2. So now you think that you can adjust the losses. So you have created a deferred tax asset. Deferred tax asset will be discussed in IAS 12. When you have carry forward losses, you can set off against future income. So you will have tax saving in future that give rise to deferred tax asset. Now the question is, you will recognize deferred tax asset. Deferred tax asset account debit. But what about the credit? This company is asking you, can we adjust it against the goodwill recorded based on preliminary purchase price allocation? Yes or no? Goodwill was existing on 1st April. but this situation have carry forward loss had arisen, but this situation of profit has come after the date of acquisition. It does not provide you more information about a condition which was existing on the date of acquisition. As on the date of acquisition, this situation that you will have enough profit in future was not there. Okay, so the answer is no. It is a situation which have arisen after the date of acquisition. We have to see the condition as on the date of acquisition. So write down the answer. As per IFRS 3, changes to the net assets are allowed. Changes to the net assets are allowed. Which results from the discovery of a fact, which existed on the acquisition date. Now read the problem. This situation that they have mentioned, that you have made enough profit and will be able to recoup the losses, this situation have arisen after the acquisition date. This contract was won after the acquisition date. Okay, this contract was not in existence on the date of acquisition. But carry forward loss is recognized as deferred tax asset only if there is a sufficient evidence that in future you will have taxable income. That situation was not there on the date of acquisition. Had it been there, then yes. If you made mistake in assessing your future taxable income, then it will be considered. But in this question, what is the problem? The problem says that on the screen, if you want, we can read it again. Entity Y had significant carry forward losses on which DTA was not recorded due to lack of convincing evidence on the acquisition date. Yeah. So, and then however on 31st March 2000 X2, entity won a significant contract. Now this is a transaction of post acquisition date period. This cannot be taken as a condition existing on the acquisition date.
Yes, but is it not like getting some additional information?
It is not additional information relating to the date of acquisition. On 1st April this contract was not there. So subsequent event should give you information on 1st April 2000 X1. Now this transaction was not in existence only. Suppose this was in existence but you are not aware about it. Then you can do the adjustment in goodwill. But the example says entity Y won a significant contract. So this is clearly a case of post acquisition transaction. And therefore this cannot be used for adjusting the figure of 1st April. So write, as per the requirement of IFRS 3, changes to the net assets are allowed. Changes to the net assets are allowed, which results from the discovery of a fact, which existed on the acquisition date. However, change of facts, now write this paragraph, this will convince you. Change of facts resulting in recognition and derecognition of. Change in facts resulting in recognition and derecognition of assets and liabilities after the acquisition date will be accounted in accordance with other IFRS. Will be accounted in accordance with other IFRS. In accordance with other IFRS. Okay. Now write down one more line. In the above scenario, DTA was not eligible for recognition. In the above scenario, DTA was not eligible for recognition on the acquisition date. DTA was not eligible for recognition on the acquisition date, and accordingly the new contract on 31st March 20x2 will tantamount to change of estimate. And accordingly will not impact the goodwill amount. And accordingly will not impact the goodwill amount. And accordingly will not impact the goodwill amount. This transaction which has taken place in this problem is altogether a new transaction after the acquisition date. Now one more question. Question number 52. Parent acquires 80% of the subsidiary for rupees 60,000. The subsidiary's net asset at the date of acquisition were rupees 62,500. Subsidiary's net asset on the date of acquisition is 62,500. And what is your stake? 80%, 60,000. In the year following the acquisition, but within 12 months of the acquisition date, it was identified that the value of the land was rupees 2,500 greater than recognized on acquisition. Now this is a situation pertaining to date of acquisition. So you have to now do the necessary adjustment. Write down question, do the necessary adjustment. Pass the necessary adjustment entry. So what is the necessary adjustment entry? But first I like to check how much was the goodwill recognized earlier. Anybody goodwill? Provisional accounting, write down year 1. Write neatly. Provisional accounting year 1. Cost of investment 60,000. And what about the NCI? We can take NCI on the basis of net asset. Net asset is 62,500. So 20% of that, 12,500. There, and less net asset on the date of acquisition. Less net asset on the date of acquisition. Net asset is 62,500. Write in notebook properly. All these adjustment they give as a part of a bigger problem. Okay. So don't ignore them. Goodwill is 10,000 right now. On the basis of provisional accounting, goodwill is 10,000. Written. Goodwill is 10,000. But what they are saying, that you found that the value of the land was 2,500 more. So the same calculation we will do, see on the screen. Now this net asset I will not take 62,500, I will take 65,000, but that will also change NCI. And then compute the revised goodwill, and then we'll make adjustment in 3 accounts. Okay. So this is the entry that we had passed on the date of acquisition. See on the screen. On the date of acquisition we had passed this entry: net asset account debit 62,500, goodwill account debit 10,000, to bank account 60,000, and to NCI 12,500. So this entry we have passed, but then within 1 year we realized that the value of the land was actually 2,500 rupees more. So now next heading, write down calculation of revised goodwill. Calculation of revised goodwill due to new information. Calculation of revised goodwill due to new information. Cost of investment will be 60,000. Add NCI. Add NCI. Now NCI will change now. 20% into bracket 62,500 plus 2,500. Is it 13,000? Less net asset on the date of acquisition. $65,000. So therefore revised goodwill is 8,000. Therefore revised goodwill is 8,000. Okay. Revised goodwill is 8,000. Now what is the rectification entry you will pass? So journal entry after acquisition. I will need to increase the value of land by 2,500. And I will decrease the goodwill value by 2,000 to goodwill 2,000. And I will need to increase the NCI value by 500 to NCI 500. Okay. So this is an example where we have to give retrospective adjustment if we get additional information within 1 year. So 2 examples I have taken. One where we will not give the retrospective effect, and this example where we'll give the retrospective effect. Okay. Now dear student, come to next paragraph. Determining what is a part of business combination transaction. Determining what is a part of the business combination transaction. Now this paragraph, what they are trying to do, when business combination takes place, you are making payment of purchase consideration. So one has to see what portion of purchase consideration is for business combination and what portion of the purchase consideration is for pre-existing relationship. Okay. And this portion will be treated as consideration for acquisition accounting. And this will be treated separately as per the respective IFRS. Is it right? Like for example, A acquires B. A is a debtor, B is a creditor. So B is supposed to receive 100 rupees from A. So what A did, A made a total payment of 1200 rupees. and this settles the bill of B also. This settles the bill of B also. So in this case I will say actually 1100 was towards acquisition of business and 100 rupees was paid to pay the outstanding balance. Right? But that was a very simple example. So one has to evaluate the entire facts and circumstances and arrive at what portion of the consideration will be treated as a part of business combination transaction and what portion of it will be treated as a pre-existing relationship. Loan given, loan taken, debtor, creditor, bills receivable, bills payable, or any other previous related dues also may be settled along with the consideration. So quickly we'll go through it. The acquirer and the acquiree may have a pre-existing relationship like debtor-creditor relationship, borrower-lender relationship, or other arrangement before negotiation of business combination began. They may be fighting a case also in the court of law. They may enter into an arrangement during the negotiation and that is separate from the business combination. So what we will have to do, in case if any consideration is paid, that consideration we divide between what is paid for business combination and what is paid for separate arrangement or pre-existing relationship. Okay, like for example, we will discuss below also, we are telling the employees of the other company that if you continue, we'll pay you 10 lakh rupees. And they pay 10 lakh rupees in advance to those employees. Now that 10 lakh rupees is not for business combination. That 10 lakh rupees is a separate arrangement to receive the services of the employee for future period. Is it right? So that will be treated as a prepayment of salary, remuneration, rather than forming part of business combination. In either situation, the acquirer shall identify any amount that are not part of the acquirer and the acquiree or its former owner exchanges business combination, that is the amount that are not part of the exchange for the acquiree. So one has to see, and there are few questions on this paragraph. You have to be very careful. Some payments may not relate to business combination. So that will be excluded from consideration. Acquirer shall recognize as part of applying the acquisition method only the consideration transferred for the acquiree and the asset acquired and liabilities assumed in exchange of the acquiree. What we have to recognize, only the assets and liabilities acquired as a part of business combination. Separate transaction will be accounted as per relevant IFRS. But then the question is, you have to identify that separate transaction. Okay. A transaction entered into by or on behalf of the acquirer. Now the standard has given some guideline. Okay. And this guideline will help us whether this transaction relates to business combination or is it a transaction related to other than business combination. If it relates to business combination, it's a part of consideration, acquisition accounting. If it is other than business combination, then it is to be accounted as per other relevant IFRS, right? So see the guidelines quickly. A transaction entered into by or on behalf of the acquirer or primarily for the benefit of the acquirer or the combined entity rather than primarily for the benefit of the acquiree or its former owner before the combination is likely to be a separate transaction. So what this paragraph says, if the transaction was entered by acquirer for the benefit of the acquirer rather than benefit of the acquiree, then it is likely to be a separate transaction. Again, the institute is careful with the words. They have not said it is a separate transaction, but the probability is that it may be a separate transaction. And then what if it is a separate transaction? Then you have to apply the respective IFRS, not acquisition accounting for that transaction. Example of separate transaction that will not be included in applying the acquisition method. 1. A transaction that in effect settles pre-existing relationship between acquirer and an acquiree. So write in bracket debtor creditor, borrower lender, bills receivable, bills payable. Okay. Then there is an example on the next paragraph below, question 21. Can you come to question number 21 to understand the effect of this example? A transaction that effectively settles pre-existing relationship. So write, Progressive Limited is being sued by Regressive Limited. Progressive Limited is being sued by Regressive Limited for an infringement of its patent. For an infringement of its patent. On 31st March 20x2, Progressive Limited recognized an INR 10 million liability relating to this litigation. On 30th July 20x2, Progressive Limited acquired the entire equity of Regressive Limited for 500 million. So they have acquired this whole company for 500 million, and in their books there is a pre-existing relationship. What is that? Progressive will pay 10 million liability to Regressive. On that day, the estimated fair value of the expected settlement of the litigation is INR 20 million. Fair value of the liability is 20 million. You have paid 500 million to acquire that company. Now, since you have acquired that company, will that liability exist? No, because now you have become one entity only. Will that litigation continue? Will you fight with yourself? So what is the accounting treatment now? It will be treated as out of 500 million, 20 you have paid for settlement of liability and 480 you have paid towards the business combination. Okay. And the difference between 20 million and 10 million, because your book value is 10 million, will be shown in the statement of profit and loss. Right? Yes. Write down in the same place. In the above scenario, the litigation is in substance settled by business combination transaction. The litigation is in substance settled with business combination transaction, and accordingly INR 20 million being the fair value of the litigation, liability will be considered as paid for settling the litigation claim, and will be not included in and will be not included in business combination. And will not be included in business combination. Next line. Accordingly, purchase price will reduce by rupees 20 million. Accordingly, reduce the purchase price by rupees 20 million. And the difference between 20 million and 10 million will be recognized in SOPL. Will be recognized in SOPL. Will be recognized in SOPL. Okay. That is enough. Difference between 20 and 10 million will be recognized in SOPL on settlement of litigation. There is one more question number 53. Question number 53 on a similar situation. X Limited acquired the business of Y Limited for rupees 40 crore. The purchase consideration includes payment for settlement of a lawsuit against X Limited rupees 30 lakh. In the books of X Limited, there is a provision for lawsuit amounting to rupees 40 lakh, but Y did not recognize any asset as it would have led to the recognition of a contingent asset. One party has recognized the liability, other party has not, because it may amount to recognition of contingent asset. X Limited has also recognized deferred tax asset of rupees 12 lakh. So 30 lakh into whatever tax rate, 12 lakh they have recognized as deferred tax asset. Fair value of the identified asset acquired is rupees 45 crore and fair value of the liabilities assumed is rupees 10 crore. Deferred tax liability worked out based on tax base of acquiree, and the fair value is rupees 1 CR. So that they have given the calculation. Don't check. Pass entry accordingly. How should company recognize the business combination transaction existing relationship? Assuming that the tax authority will not allow any tax benefit on this settlement, since the payment occurred during negotiation of the business combination. So what I'll do, this total consideration paid is 40 crore and out of that we have recognized in our book 30 lakh. 30 lakh is towards this settlement. So this 30 lakh will be deducted from 40 crore. So the amount paid towards consideration is how much? 39.7. So consideration paid will be treated as 39.7. Next thing, you have paid 30 lakh rupees to settle a liability which is appearing in the books at 40 lakh. So you remove this 40 lakh also from the book. You remove this 12 lakh also from the book, because the problem says income tax department will not allow you the deduction for the payment made during business combination. So now the DTA will be a waste. Okay, reverse that also. You recognize 45 crore rupees new asset acquired. You recognize 10 crore rupees. You recognize DTL 1 CR. And you also recognize 39.70 consideration paid. So that will also give rise to some difference which will go to goodwill or GOBP. GOBP. Gain on bargain purchase. Okay. So what journal entry we will pass? First understand, total consideration paid is 40 crore, which includes 30 crore rupees for settlement of lawsuit. So towards business combination, you have paid only 39.70. Is this diagram understandable? Our topic is right now, in a business combination deal, sometime the consideration may include settlement of pre-existing relationship or some other arrangement which is not a part of business combination. Solve. Written this much? Not written. Write in the center amount paid 40. Left side payment for settlement of lawsuit 0.30. Right side towards business combination 39.70. And then you pass journal entries. Write in the question, pass journal entries. Journal entry, write down first entry for acquisition. First entries for acquisition, all figures are given to you. Asset acquired in business combination 45, assets account debit 45. Goodwill account debit, balancing figure, we'll discuss later. Two liabilities, how much is liabilities? 10. To deferred tax liability, to deferred tax liability 1. Asset will close separately, that is a pre-existing account. And to bank account 39.70 towards combination. Check goodwill figure. Balancing figure is goodwill 5.70. Write balancing figure. Second entry, write down, you write off this DTA account which is existing in your books. P&L account debit 12 to DTA account 12. Reversal of deferred tax asset. The reversal of deferred tax asset. And then you write down third entry, settlement of that lawsuit entry. Provision account debit 0.40 because the carrying amount is 0.40. Settlement is made by paying 0.30. So therefore difference 10 gain to P&L account. To profit and loss account 0.10. Is it right? Say yes. To bank 0.30. Payment for settlement of lawsuit. The topic is still going on. That was just example on pre-existing relationship which should be treated as separate transaction. That example number 1 we have discussed. Now second example. Second example is a transaction that remunerates employee of former owners of the acquiree for future services. A transaction that remunerates employee of former owners of the acquiree for future services. Now understand the practical scenario. Okay. This is one company, let us say FB, name of the company. This is another company, let us say WA. Okay. FB acquired WA. Now they have also asked the owner of WA that you please continue with us. You please continue with us, because if you only sell the business and you move out, who will manage the show? Right? So normally in case of business combination, we ask the previous owners of the acquiring company to join the acquirer company in some capacity, because they will be the people who will run the business. They know the business. All of a sudden my employees can't handle that business. Okay? And then you say, we will pay you 100 crore rupees. Give 5 crore rupees as a signing bonus for rendering the service for next 2 years. So in this case, my consideration for business acquisition is only 95 crore. 5 crore we are paying for future services. So this 5 crore will be treated as advance payment to employee, and 95 crore will be treated as a consideration paid. But again here, in the next few paragraphs we have to see, does that payment really mean it is for remuneration, or is it a contingent consideration also? So then that is another discussion. But for the time being, you just assume employees are promised to be given 10 lakh rupees or 10 crore rupees if you continue for a year till our business settles down. Now question, note down. Let me first check whether this exists in your book. X Limited plans to acquire Y Limited. First you check whether it is printed in the book. X Limited plans to acquire Y Limited. It was identifying assets acquired and liabilities assumed. The company agreed to pay Y Limited's existing management rupees 10 million for running the business of acquired business for 1 year during the post-acquisition period and harmonization of post-acquisition activities. Should this agreement be treated as a liability assumed in business combination, or should it be treated as a separate arrangement? Should this 10 million that you are going to pay to the previous management so that they can acquire, they can come with you, they can help in harmonization of post-acquisition activity, separate transaction or part of business combination? Separate, sure. Yes, the answer is one line. It is payment for future service. You want to write? No. Why? Understood? Okay. Your choice. A similar example will come in a different, bigger problem. Okay. Next line. One more example. A transaction that reimburses the acquiree. A transaction that reimburses the acquiree or its former owner for paying the acquirer's acquisition related cost. Suppose the acquiree has paid the due diligence cost and it is reimbursed by the acquirer. Will it be a part of business combination? No, it is a separate transaction and it will be treated as an expense separately. Factors determining whether the transaction is separate from business combination. Few examples we solved today were simple in nature, but sometimes the arrangement may be complicated. So there is a guideline and you follow this guideline and accordingly decide whether this arrangement is a part of business combination or whether this arrangement is a ST, separate transaction. Okay. So example, reason for transaction. This point 1 we have discussed. Is the transaction arranged primarily for the benefit of the acquirer or the combined entity? Then the primarily for the benefit of the acquiree or former owners before the combination. Then that portion of the transaction price paid and the related asset or liability is less likely to be a part of exchange for the acquiree. Accordingly, the acquirer would account for that portion separately from the business combination. So summary of this is, if the transaction is designed primarily for the benefit of acquirer, it is likely to be a separate transaction. Example also I think I have written in your book, check. Remuneration paid to senior management for services to be rendered during post acquisition does not form part of purchase consideration. Write down this example given. Write little fast. In point number 1, why we have entered into a separate transaction? In this case, we want that the senior management of the acquiree should continue so that it will help us in managing the business better in the initial year. This transaction is going to benefit whom? It is going to benefit the acquirer more, because there will be easy transition, smooth transition. Acquiring a business with so many people around is not an easy task. So you need the support of senior management. And if you are compensating the senior management for staying for some more years, it is more likely to be a separate transaction. I hope you have noted remuneration to senior management for services to be rendered during post acquisition does not form part of purchase consideration. Okay. Next, second point, who initiated the transaction? If there is a special transaction, ask who initiated the transaction. Point number 2 and point number 3 in your book are same actually. A transaction or other event that is initiated by the acquirer may be entered into for the purpose of providing future economic benefit to the acquirer or the combined entity, with little or no benefit received by the acquiree or its former owners before the combination. This transaction will be treated as separate transaction if it is initiated by the acquirer, which will generate benefit for acquirer in future, little or no benefit to acquiree. On the other hand, a transaction or arrangement initiated by the acquiree or its former owner is less likely to be for the benefit of the acquirer or the combined entity and more likely to be a part of business combination transaction. So who initiated the transaction matters. Acquirer, separate transaction. Acquiree, part of business combination. But again, these are only indicators. One has to further examine the respective case. Point number 3, timing of transaction. When did transaction occur? When did transaction occur? For example, a transaction between the acquirer and acquiree that take place during the negotiation of the terms of business combination may have been entered into in contemplation of business combination to provide future economic benefit to the acquirer or the combined entity. If the answer is yes, a transaction entered into for the benefit of acquirer or combined entity. If so, the acquiree or its former owner before the combination are likely to receive little or no benefit from the transaction, except that they receive as a part of the combined entity. So this transaction will be treated as a separate transaction if it is entered into during the process of negotiation and is likely to benefit the future economic for the combined entity. This question number 21 we have done? Sure. When? Today only. Okay. Now next very complicated paragraphs are appearing. So next 2 pages, hold your breath. they are saying that sometime the owner of the previous company, they are asked to become employee of the acquirer. Why? Already told you that because they know the business. Okay. If you acquire just a company and you keep the owners aside, it is very difficult to run that business because the owners know everything about that business from A to Z. Employees don't know everything. Some employees only know how to switch on the classroom computer system. Okay. He does not know about what goes in accounts department. The one who knows accounts, he does not know how the classroom operates. Only the owner knows how both systems operate. And therefore they are asked to continue. And they will get some payment if they continue. Now whether that payment that they will get for continuing, is it a remuneration or is it a contingent payment? Is it a remuneration or is it a contingent payment? Is it right? So whether the arrangement for contingent payment to employees or selling shareholders are contingent consideration. If it is contingent consideration, it will form part of business combination. But if it is a separate transaction, then it will not form part of business combination and it will be recorded as a separate transaction. So whether it is a contingent consideration or separate transaction depends on the nature of the agreement. Okay. Now you have two choices. Either you read the whole theory, then read the summary, or only read the summary. Choice. Summary. Why? Same thing is written here. Okay, we'll read the summary, but before that, there is a question also. At least to answer this question, first I have to read this portion of the theory part. Topic is, if you understand what is topic, then you will understand the concept. If we have paid or we are going to pay something to the former owner of acquiry who becomes the employee, okay, whether this will be treated as contingent consideration or whether it will be treated as remuneration or separate transaction. That is the topic. Now you don't decide. Situation, facts and circumstance, okay. Don't come to a single conclusion. So the standard gives you some guideline. The terms of continuing employment by the selling shareholders who become key employees may be an indicator of the substance of the contingent consideration arrangement. Now see, a contingent consideration arrangement in which the payments are automatically forfeited. Payments are automatically forfeited if the employment terminates is remuneration for post-combination service. If you work for 2 years, we'll get so much amount. Okay, but in case if you leave before the agreed period, your payment will be forfeited. Then this will be in the nature of remuneration for post-combination service. An arrangement in which contingent payments are not affected by the employment termination may indicate that contingent payments are additional consideration rather than remuneration. If the payment is not affected even because of termination, then it is an additional consideration you are paying. But if the payment gets terminated or forfeited because your employment gets terminated, then it is a payment towards remuneration. Okay. So on this point, there is one question on the next page, 22 number. KKV acquires 100% in Viva Limited, a company owned by a single shareholder who is also the KMP in the company. for a cash payment of USD 10 million and a contingent payment of USD 2 million. Cash payment 10 million is a part of consideration, but there is a contingent payment of USD 2 million. And what is that contingency? The terms of the agreement provide for payment after 2 years. The terms of agreement provide for payment 2 years after the acquisition if following conditions are met. EBITDA margin of the company after 2 years after the acquisition is 20%, 21. And second, the former shareholders continues to be employed with Viva Limited for at least 2 years after the acquisition. No part of the contingent payment will be paid if the former shareholders does not complete the 2-year employment period. Separate transaction. 2 million separate transaction. 10 million business combination. Okay. So this amount that will be forfeited if the employment is terminated will be treated as separate transaction. Write down. In the above scenario, the former shareholder is required to, continue in employment. And the contingent consideration will be forfeited. If the employment is terminated or if he resigns. If the employment is terminated or if he resigns. Next line. Accordingly, only USD 10 million is considered as purchase consideration. Accordingly, only USD 10 million is considered as purchase consideration, and contingent consideration is accounted as employee cost. And contingent consideration is accounted as employee cost and will be accounted as per other IFRS. And will be accounted as per other IFRS. And will be accounted as per other IFRS. Okay. So now what I have done, the entire big paragraph is given in a summary form also. Where is the summary? Yes. Is summary printed in your book? Yes, I know. So in that summary, the summary of previous page is there. Look at the indicator. If this situation persists, it will lead to conclusion as remuneration. And if this situation persists, then it will lead to conclusion as contingent consideration. One example we discussed just now. Continuing employment. If the payment is forfeited on termination of the employment, refer example 22, the consideration is towards remuneration, separate accounting. If the payments are not affected by the termination of employment, lead to conclusion as contingent consideration, and then you have learned contingent consideration will be accounted at fair value. fair value, and it will be a part of business combination accounting. Second, duration of the required employment. If the duration of the required employment coincides with or exceeds the payment period. So what do you mean by this? That is, suppose contingent consideration will be paid after 2 years, and the required duration is 2 years or more, 2 years or more. Then in that case, the payment is made towards remuneration. But if the duration of required employment is less than the payment period, then it is a contingent consideration. Duration is 2 years, this is 2 years, and you have to only serve for half year. Then the example would be, it is a contingent consideration. Third is level of other elements of remuneration. Third indicator is level of other elements of remuneration. When will it lead to remuneration and when will it lead to contingent consideration? If the level of other elements of remuneration is not reasonable compared to other employees, any other element of remuneration not reasonable compared to other employees. So the standard says this will lead to conclusion as remuneration, and is reasonable compared to other employees, it will lead to conclusion as contingent consideration. Does it look opposite? We'll read from the detailed version. Paragraph C, previous page. Previous page, paragraph C, level of remuneration. Situation in which employee remuneration other than the contingent payment is at a reasonable level in comparison with that of other key employees in the combined entity may indicate that the contingent payments are additional consideration rather than remuneration. But this is, we are talking about other payments, situation in which employee remuneration other than contingent payment is at a reasonable level in comparison with that of other key employees in the combined entity may indicate that contingent payments are additional consideration rather than the remuneration. Okay, explain. There are two components. One is contingent payment, employee remuneration. Employee remuneration is comparable with other employees.
And that contingent portion is considered as additional consideration.
That contingent portion is considered as other than the remuneration. Next point, 4. Incremental payment to other than non-employee selling shareholder. Other non-employee selling shareholders receive lower additional payment on a per share basis. Then it will lead to remuneration. And other non-employee selling shareholders receive similar additional consideration, additional payment on a per share basis. Then this will lead to contingent consideration. Same thing. And next is number of shares owned when all selling shareholders receive the same level of additional consideration. So number of shares held before acquisition. If all shareholders receive same level of additional consideration, if the number of shares held is substantially high, okay, then it will lead to conclusion that the payment is remuneration. But if the number of share held is very small portion and still you are getting the same level of additional remuneration, additional consideration, then that will lead to contingent consideration. One more, formula for additional payment. If formula is linked to performance indicator like earning, then it is remuneration. But if the formula for additional payment is linked to valuation of the entity, like multiplier of earning, then it is more likely to be a contingent consideration. This question we have covered. Okay. Now we'll solve some questions before the next round of theory starts. Okay. So what we have covered so far, can you make a small summary of that? What we have covered? What is business? Business combination. Then there are 6 steps to business combination. And then we have also covered many miscellaneous issues while reaching this point. Pre-combination relationship, those transactions which may not be accounted at fair value, etc. So solve this question now. So it will come to up to whatever we have discussed till now. Based on that, some questions I am going to ask you on the screen. Question number 27. On 9th April 20x2, Shyam Limited, a listed company, started to negotiate with Shyam Ram, which is an unlisted company, about the possibility of merger. On 10th May, Board of Directors of Shyam authorized their management to pursue the merger with Ram Limited. Point C. On 15th May 20x2, management of Shyam Limited offered management of Ram Limited 12,000 shares of Shyam Limited against their total shareholding. 4. On 31st May 20x2, the Board of Directors of Ram Limited accepted the offer subject to the shareholders' vote. On 2nd June, both companies jointly made a press release about the proposed merger. On 10th June, the shareholders of Ram Limited approved the terms of the merger. On 15th June, shares were allotted to shareholders of Ram Limited. The market price of shares of Shyam Limited were as follows. There are so many dates given, price given. The question is, what is the acquisition date and what is the purchase consideration? June. Shareholders have approved the merger. What about 15th June? Shares were allotted to shareholders of Ram Limited. So will you take 10th June or 15th June? Vote for 10th June. Vote for 15th June. Vote for 2nd June. So only 2 votes we have got, one on 10th June and one on 15th June. So which is the right answer? Can you control the other company without the shares allotted to you? Even though your board have approved the merger. Board has approved the merger, but to control, you need something. Is it right? And that something you will get only after the shares have been allotted to you. You can't start directing the financial and operating policies from 10th of June. You cannot direct relevant activities from 10th of June. Both parties have agreed on 10th June, but finally the control will get transferred on 15th of June. And then we'll take 15 June price somewhere below 90. 90 into number of shares. How many shares were acquired? 12,000 shares were acquired. So multiply by 12,000. 10,80,000. You want to write the answer or only understand? Right. Then write briefly. As per IFRS 3, the acquirer shall identify the acquisition. The acquirer shall identify the acquisition, which is the date on which it obtains control. Which is the date on which it obtains control of the acquiree. Okay. Then write the acquisition date will be the date on which shares were allotted. The acquisition date will be the date on which the shares were allotted to the shareholders of RAM Limited. The date on which shares were allotted to the shareholders of RAM Limited. Although the shareholders' approval was obtained on 10 June, but the shares were issued on 15 June. And accordingly, rupees 90 will be considered as market price. And accordingly, rupees 90 will be considered as the market price. Therefore, purchase consideration equal to 12,000 into 90, rupees 10,80,000. Okay. Now we will take a break.